Hi, everyone. This is Michael Girali with Bespoke Retirement Advisors and our Healthcare Genius and Tax Free Genius YouTube channels. And today we're really excited to have Nico Cantoris as well as Kevin Kelly with us from Performix to talk a little bit about life insurance policy management. So I'm going to let Nico kind of kick things off, give us some background on his history as well as Performix, and then we'll talk a little bit about Kevin, and we'll go into some questions.
Awesome. Thank you, Michael. I appreciate you having us. We're super excited. Anytime that, we have the opportunity to speak about what Performix does and where we play in the space, we love it. And we're excited, to share that information here with you and your followers today. So as Michael mentioned, my name is Nico Cantoris. So I'm the Director of Customer Success with Performix. So have a software background within my career, new to the life insurance industry when I came on board 3 years ago with Performix, but has been a tremendous opportunity and excited for the industry to bring such a much needed platform and technology to help our customers, advisors, distributors, all the way up to the financial institutions with their policy management processes and workflows. So Performix has been around roughly six to 7 years. Our founder, Mike Pepe, was a advisor, so he sat in many of the shoes that you guys are in today. He started out as a captive agent with Mass Mutual, and then went on to be an independent producer and had a very successful career. In doing so, though, he was able to find new opportunities and better service his clients by creating additional touch points through managing the policies that they already had or that they had previously sold. He had previously sold them. So that's where kind of Performix came about, is from an actual producer utilizing a early version of the technology, right, to service his clients and provide them just better solutions through doing reviews on a regular cadence so that he could stay ahead of any potential issues or problems that arise throughout, the life insurance policy. So, so that, from those times way back when, Mike has brought on, a tremendous team. Kevin Kelly, who is with us on the call right now, he's one of our senior insurance specialists. Kevin has been with the team for going over 2 years now, if not 3, as well. And really, bringing in insurance experts that have worked with carriers or been on the case design side, been on the producer side, has really helped us kind of dial in the product to service our clients' needs better and just produce better results for your client. So excited to share some of how we do that in today's call.
Great. Thank you, Nico. I appreciate it. And Kevin, good to have you as well. Looking forward to hearing what you have to say. So, Nico, let's start off with, why is policy management so important, especially given today's market environment? Obviously the market, I think, is rebounding today, but has been down over the last, month or so. But also just the different types of policies that exist today versus maybe 30 years ago.
Yeah, absolutely. So why policy management is so critical? Not, obviously, given everything that's going on in the world today, inflation, some of the hurdles that we've had over the last couple of years, it has made it more of a priority or a necessity to review the existing book of business that you have. Performix, and what we've seen, right, with our advisors and clients that are in the platform, they've taken the opportunity to create additional touch points due to, those VUL policies or those permanent policies that might need to get reassessed, right? A perfect opportunity, depending on how the market is currently going, right, is to reach out to that client and not just have a cold call or just just an out of the blue outreach to that client, but to actually perform a review, right? Do a complete analysis of that policy and how it has been been performing given these economic circumstances, and then really assess what is the best possible solution for that client, giving the needs right now, right? When they bought that policy or that product, it might have made sense for them, 10, 15, 20, 30 years ago, right? Now carriers try to be a lot more aggressive and offer better products based off of what's out there now. So there could be a better product for that client, given how their needs and just life has changed since the origin of that policy being sold. And that's what we're seeing across the board for our clients, right? And who are our advisors that are in the platform. They're performing these reviews on these permanent policies and able to just provide a better solution for that client. So, and Kevin will go into a little bit more detail specifics as far as the type of policies that we're seeing folks just find new opportunities on.
Sure. And, I think that's a great point, Nico. And I think also just given the fact that what you see with insurance, I think people tend to think of it as an event where they purchase a policy, it's done, they can put it in their safety deposit box and not have to think about it. But unfortunately, with today's policies, I think specifically, a lot of them really do need to be managed just like your investment portfolio would be.
Yeah, absolutely. We're seeing it more of an asset class that, the more you put into it or the little you put into it is going to affect the outcome at the end of the day when you actually need that policy. So it absolutely, the best kind of clients that we have are the ones that are performing those annual reviews, reaching out to the carriers through our platform to automate requesting and receiving that information. So, we understand that our clients are trying to do the best for their clients and don't have the time to reach out and call the carriers and get that information. So that's where we kind of fill the void of helping automate that process. So absolutely a necessity to review those.
Yeah, and I think that's actually kind of a good segue here. When you look at Performix, you have so much data just by running these policy reviews and where you can kind of look at overall trends. And so I think, we'll ask you a couple of questions, and I think this will probably go to Kevin, I believe, next. But, when you're looking at policy reviews on the aggregate, because you certainly, I think, do some aggregate studies, what are you seeing as far as a percentage of policies, Kevin, that might be off track where, and what we mean by that obviously is that the initial illustration that was run when the policy was purchased no longer necessarily holds up or will work given what's happened in the investment environment or the market environment.
Yeah, and that's exactly what we're running into too as well, Mike. Is policies are put into existence in a particular year, a given year, let's say 10 years ago, and then over that 10-year period of time, everything's changed. Economically, things change. If it's a fixed credit grade on the policy, like a UL or something like that, that crediting rate's going to have changed over that period of time. So it's right. You're right. They need to be evaluated and reviewed on an annual basis. But as far as the percentage that we find that are off track, it really varies by the user. Those users that are more engaged with their clientele that conduct the annual reviews, they're, as you might expect, you'd find that their policies tend to be a little bit more on track, as opposed to the user who may have purchased a book of business and he's looking at it saying, "Okay, how do I wrap my arms around this new book of business? Where do I start? Which are the ones we start with?" And Performix has what we call our risk model, and it'll take the information on all the policies that are, maybe that's a book of 1,000 policies that he purchased, and we'll run them through that risk model and say, "Listen, these policies here, why don't you pay attention to this, these 20 first, and then these 50 second, and so forth." So it does have a way to prioritize the attention that needs to be paid. So, but there are, in any given case, there are policies that attention needs to be paid to.
Yeah, and I probably should clarify too, that Performix really works with insurance agents, financial advisors, and so forth, not directly with the public, but obviously what we're trying to do here is educate the public about, what they should be looking at and thinking about, just in case, their advisor's no longer in the business or they haven't heard from them in a while. That's so when we're talking about these aggregates, we're really talking about what we're seeing from insurance producers who are doing the reviews through Performix.
Absolutely, Mike. And you and I have been in the business long enough to know that we've seen producers come and go. It does happen, and those policies that were inherited by somebody else, that whoever inherited that policy, they might not know what the servicing understanding was at the time they took that policy over. Maybe the understanding was is we're going to agree to review this once a year, once every 5 years, or you bought this policy as part of your retirement planning as strategy or so forth. Yeah, those are opportunities, review opportunities that need to be called out, and the Performix model really help prioritize those policies and get the producer in front of the people that need the conversations first.
Yeah, that's great. Yeah, orphans, I think we call them, right?
Yeah, exactly. Yeah, exactly. In a lot of cases, that's exactly what they are.
So another question that comes up, obviously, permanent policies, when we're talking about UL or universal life or variable universal life, VUL, indexed universal life, IUL, and whole life. I mean, those are some of the different types of permanent policies. But when it comes to term insurance, again, another area where traditionally I think people feel like, well, why do I have to manage a term policy? I bought it for 10 years, my premiums level there. So maybe expand upon that, how Performix really helps on that side of things, making sure that you don't get surprises when the term of your insurance ends.
Sure. Just like you said, somebody may buy a policy for a term policy for a very specific reason. They're buying a 10-year term policy, as you mentioned. A lot of times it's set it and forget it. They buy the 10-year policy. They do exactly like you said. They stick it in the desk drawer, they stick it in the safe deposit box, and don't even think about it. Well, a lot of times what happens on those is they go, now, when was it that I bought that 10-year policy? Was that 5 years ago? Or was it 7 years ago? Or was it 9 years ago? So managing that policy, that timeline of that policy, so that a couple important events aren't lost in space. And the two important events that we look for is, number one, is the end of the level term period. So is that when you go to have that review with that client, is that level term period, is that still in lockstep with where you want to be? You bought a 10-year term. We're at the end of year 9. You got one more year of level term premiums. What do you think? And then the other important point we don't want to miss is many of the policies, the term policies out there, are convertible term. And you and I both know what convertible term is. That's term insurance that could be converted without evidence of insurability into a permanent policy. So if somebody bought that 10-year policy 9 years ago, and over that same period of time, they've had a change in health that might make them otherwise uninsurable, boy, there's one thing you don't want to miss is that conversion date, because that could be an issue. So yeah, sometimes it seems like term insurance should just be, just simply set it and forget it. I mean, it's term. The premium doesn't change. The coverage doesn't change. But chances are it doesn't even participate in dividends like some of the old ones used to. So it just sits there. But yeah, you really want to keep a close eye on those.
Okay, great. Thank you. Another area that we get asked, whole life insurance, which is really the oldest type of permanent insurance. And I think a lot of people feel like, well, okay, does that really need to be managed? Maybe give your opinion on that one, Kevin.
Sure. Yeah, whole life policies, again, just like you said, they're one of the old line. Back in the day, there was whole life and there was term insurance and there was really nothing else. So, but those old whole life policies, especially the policies that, let's call them the contemporary purchases of whole life, they may have been bought for not only just the protection, but for the cash accumulation that's going to be inside of those policies as well. And as we've seen over the last 10, 15, or 20 years, most of those policies that we see, at least on the Performix platform, those whole life policies, most of those are participating or dividend paying policies. And what we've seen is those dividend scales have gone the way of the interest rates, down, 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 down. So what you want to look at is, listen, I bought that policy as one of the building blocks of my retirement plan. How does that change in dividend scale? How does that impact that? Am I going to have to start saving elsewhere to make up for the shortfall that's going to be part of that policy? Maybe the policy was purchased with the idea in mind that, hey, by the time I hit retirement, I'm going to go ahead and let the dividends make the premium payments for me. I'm going to keep the coverage, but I'm going to go ahead and let the premium payments be paid out dividends. What if those aren't sufficient? Is that going to impact? Is that going to bring up another cost in retirement that you weren't planning on, 10 years ago? So to that extent, whole life really should be managed and followed. Yeah, maybe not. It doesn't have as many, as what we like to say, as many moving parts as the ULs and the VULs and the IULs, but it still has some things that you got to pay attention to.
Sure.
Yeah, I'll just add on, Michael, before that, the nice part with what our advisors that leverage Performix, right? Something that the client should ask for, right? Even on the term or whole life, right? Ask these kind of questions, right? When am I able to convert my policy up until, right? Or, if I continue at this path, what's going to be the outcome at 10 years from now, right? Those are the kind of answers that, if an advisor is managing that policies, they should be able to produce pretty quickly, either given Performix or outside of our platform, right? So just for the folks that are listening in, I think, the tidbits and the, kind of information that you should be asking of your producer, your advisor that sold you that policy are right what Kevin was touching on, those kind of key pieces to just on an annual, even semi or every other year basis, right? Ask those kind of questions so that and are confident that, the coverage will be there when you need it.
That's right. Great point, Nico. Thank you. So another thing that we know can have an impact on policy performance are loans. And this often gets overlooked, I think. I use an example of a policy that my uncle purchased, well, now probably 60 years ago, and had used loans to pay some of the premiums, so he wasn't paying out of pocket. And as he got into his 70s, all of a sudden the policy no longer had cash value, and actually the policy lapsed, basically was no longer in force. And when that happened, he got a tax bill or a 1099 from the insurance company saying that he owed taxes on all of those things. So maybe, Kevin, talk a little bit about loans and what you're saying, how those can really impact policy performance.
Yeah, no question about it too. And loans on a life insurance policies, that you really need to keep eyes on those, because there's no set repayment schedule on a policy loan. It's not like when they take out that policy loan, like when you took out a mortgage on your house or you borrowed to purchase an automobile or something like that. You got a payment book or you got a payment schedule. They told you, listen, every the first of every month, we're going to draft X number of dollars from your checking account, make sure it's there so this loan can be paid off. Doesn't happen like that in a life insurance policy. It just sits, for better or for worse, it just sits out there at a predetermined or maybe a variable interest rate. And every year there's a notice that's going to come in and says, the interest that's due on the loan is X. What if you don't pay that? And because, again, you're not obliged to pay that. You look at somebody may get that in the mail. They call their representative or their agent or their advisor and say, hey, listen, I just got a bill in the mail for $1,900 for this loan interest. Do I have to pay that? Well, technically, no. That's all I needed to hear, Yeah. and they're done. But the scary part about it is if you don't pay that, it's not like it goes away. They capitalize or add that interest onto the principal of the loan. Next year, your loan interest payment's a little bit bigger. And eventually find yourself in a position where your uncle found himself, is that outstanding loan that was maybe only 50% of the policy value has gobbled up the balance of it just in interest. And now they're standing there with their hand out going, either write a check to the insurance company to keep this policy in force, or here's a 1099, make sure you include this with your taxes. So really big, really great idea to keep an eye on policy loans. And if everybody's all preaching from the same hymnal on policy loans, hey, we know it's there, we know the interest rates is being charged based on the projections you're providing us, it looks like we're going to be all set. Great, everybody knows. But if that loan's in a position or a point where it's going to consume that policy, that's a call out that everybody needs to be made aware of.
Great. And we've seen that, the perfect storm, right? Low interest rates with loans, policy not performing as well as had been originally illustrated. And not a good storm, obviously.
Right.
So now, some of the newer policies include different riders, long-term care riders, chronic illness or critical illness riders. Talk a little bit about that, Kevin, how those might impact, or if they, would impact policy performance, and again, why it's so important to be managing this if you're thinking that this life policy is going to be there for your to pay for long-term care costs if you were to incur those in the future.
Sure. Yeah. Some of like the riders and the benefits that are available now, the chronic illness rider, the long-term care riders, they have a great purpose. And that purpose is primarily to help somebody handle the high cost of long-term care should the need arise. So nobody ever bought a policy. I used to say, as a producer for 22 years, I used to say, nobody ever bought a policy because it was glamorous. They didn't buy that policy for the same reason they bought that convertible Corvette or that diamond tennis necklace for their wife. They bought the policy to address a particular need, and those needs change as we make it through life. So the reason we bought that that $500,000 worth of coverage when we were 45 is maybe a completely different reason from why we hang on to it when we're 65. And the reason we might hang on to it at age 65 is to handle those costs of long-term care. So I think the riders themselves have become a really great reason for people to hang on to their life insurance policies after they've gone beyond the point of where they're protecting earned income. So as far as the cost goes, on some of them, the cost isn't really tremendous. It's not like the cost back when people were purchasing standalone long-term care policies. Those could be very expensive. Those weren't a cheap purchase. Those might be $4,000, $5,000, $6,000 per year. And the argument against those policies is, well, what if I have the good fortune to die in my sleep one night and never go into the nursing home? I'd have spent out $6,000 a year for what? And the answer was right. You spent it for what? Peace of mind, I guess, if nothing else. So these new riders that are on the permanent policies, whether it's for chronic illness or long-term care or terminal illness riders, those give you another reason to hang on to that policy because we don't know when those will come up. But what we do know is they're eventually going to pay the death benefit from those policies. None of us get out of this life free. So sooner or later, that benefit's going to be paid. So I find those are, I think those are a watershed event for the insurance industry. I think that's a huge reason why people that are beyond their earning years buy and hold on to permanent life insurance policies now, because you just never know.
Yeah, and of course, that's again another reason why you really have to be actively managing these policies to make sure that they're going to be enforced when you need it, somewhere down the road at 80, 85, 90 for a lot of people. That make sure that you don't get off track, and that if you did get off track, that you can add additional funds and so forth to the policy to make sure that it stays active and viable. Any other things that we maybe have missed here, Nico and Kevin, with regards to Performix and things that people should be thinking about?
Yeah, I mean, I'll just say, I think we hit on a lot of good stuff and a lot of the key points that Performix is going to highlight for the end clients, in addition to for the producers when they're reviewing these policies. But Performix allows these producers to not only do that review, but also offer the solutions within a nice streamlined report, so that the end client can understand how that policy is performing and what they're going to need to do, if necessary, to get that policy back on track. Right. So, I think just, we touched on it, and the whole kind of highlight here is policy management and just the in-force management on a nice and consistent cadence is what's needed, especially during these times.
Great. Kevin, any other final points?
Yeah, I'd always thought that as being in the industry, we really have two commodities when it comes to managing a policy. We have time and money. So it's the shorter amount of time we have to correct an issue, the more money we're going to need. But if you're using the Performance platform and you can say, hey, listen, I put this policy in force, and it's ideally supposed to last through age 100. But now with these changes that have happened in the economy, it looks like, based on what we're doing right now, the policy is not going to make it beyond my age 85. What do I need to do? What kind of adjustments, course corrections do I need to make now? The earlier you can get a sense of that, the better off you are. It's a much happier conversation to have for a producer to have with his client. Say, hey, you know what? Well, you need to add an extra $100 a year on this thing to keep it going, rather than say, hey, you know what? This is going to lapse tomorrow if you don't stroke me a check for $25,000.
Right.
Yeah. So
those are certainly surprises you don't want in retirement.
No, nobody wants to see that.
Yeah.
So.
Well, Nico and Kevin, thank you very much. One thing I want to point out at the bottom of the YouTube video, you're going to find a link to Performix. So you'll be able to, if you've got questions, you can certainly go to that website. If you have an agent that you work with and you want to introduce them to Performix, then that information will be there. If you don't have somebody, or you're interested in seeing, kind of where your policy is, we'll also have a link there where we can help you out with that as well. So Nico and Kevin, thank you very much for your time.
Absolutely.
I really appreciate it, and have a great day.
Thanks a lot.
You.
You do the same.